Good afternoon, everyone. Good evening. Thank you so much for joining. I know it's a short notice. Budget has been keeping us busy. So I've joined by Manpreet from AceBiz. So AceBiz, Manpreet, accounting, federal budget, corporate filing as
Much
well.
awaited announcements.
Was that sorry?
Much awaited announcements. Everyone was waiting for this budget as to what's going to happen. So I guess now we know what's happened. It's more of a clarity, that less ambiguity, more decision making.
So it has been apparently called as the biggest tax reform in the last 25 years. Would that be something that you agree with?
I totally agree with that. Look, I have seen budgets for the last 20 years. I've been working in this industry for 20 years. This is the most complex tax reform I've seen in my career journey of 20 years. And well, again, I guess this is not a good or bad change, but for anyone who has been in the investing journey or property journey, because we're going to cover most things property, I don't think it's much of a difficult budget for a long-term investor. Well, it's a more level playing field for everyone, I guess.
Yeah, no, I totally agree. And just on the amount of effort that our dear treasurer has put in, he himself says it was actually 2 years budget bulked together in one. And of course, I'm not going to take it political, but some promises and whatnot, and Bill Short and what happened 6, 7 years ago and whatnot. So, look, this is just a general chit chat. So, thank you so much, everyone, for joining. Really appreciate for those who have switched on their camera. It's really an interactive session. So for those who can switch on their camera, that will be super awesome. There is some books that I've got to give you guys as well for more being interactive. So there's a copy that I'm holding in my hand. So if you can make it interactive, at the end, send the copy as in your address. It's a physical copy, so it will be sent by the team to your mailing address. So let's make it interactive for those who have switched on camera. Really, really appreciate it. It just makes it easy for us to bring value. I know Manpreet has been reading the budget books from front to cover.
Only for the last 24 hours.
So you manage. So this is for you guys. Like, this is what we are trying to bring. I know it's like, again, Manpreet, would we agree that this is just a proposal? It's not legislative. So would you clarify this thing for us, please?
Yes, look, this budget, of course, this is announced on a certain date. Now, some of the things do come in effect on that date, but because it's not a legislation yet, they have grandfathered some of the legislation, which means some of the pre-existing rules would apply to some people, some investors, and the changes will come into existence. Most of the changes will come into existence from 1st of July 2027. But because the budget was announced on a specific date, once these things do become a legislations, those changes will stay from that date. So, of course, as we sort of present what the changes are, you'll understand more in terms of how it will be grandfathered and who will be impacted and when it will be impacted.
Yeah. So look, I do appreciate the meaning of grandfathering, but for those who doesn't know, what do you mean by grandfathering? There's no parents. What's going on? What is it?
So grandfathering means anything that existed yesterday, meaning if today is the budget release date, any rules or regulations or law that was existed yesterday, which were applicable to some type of people. Now, what those some type of people or some type of investors are, we'll walk through that. Those rules will continue to exist for those people, so they are unaffected.
Okay, so what it means is that the current property owners, because this session is only for properties, typically, give or take. So what you are saying is that if there are any changes, they do not apply to the people who already hold the property or exchange contract before 12th of May. 7:30 p.m.
7:30 p.m. Yeah, so two things. When I say grandfathering, yes, the date line is there. So anyone who held those assets prior to that date, and there are some grandfathering rules to a kind of assets which can be purchased even after. So the rules will be still the same. So of course, there's two different definitions to grandfathering the legislation, which is the timely and the category.
Beautiful. Now we are getting into it. I can see a lot of people there. So let's find out who is dialing from where. So if you can put in the chat, again, I was saying this is very interactive. You can put in questions in the chat, but just to warm up our fingers, if you can please share which city you're dialing from, that will be super awesome. We got Nidhi, we got Sydney, Nidhi from Sydney, and lots of Sydney. Ankur, welcome, thank you. Melbourne, Sydney. So Sydney is winning.
You don't want me to. You don't want me to put in the chat where I'm dialing from.
Yeah, so you'll see all, man. You have nothing to hide. So thank you so much, Manpreet. This really means a lot. It shows your commitment. By the way, three cheers for you. Not only you are studying for 24, 36 hours the budget, you're with your partner on the holiday. Man, that's not the holiday that accountants take, do they?
No, they never take holidays.
No, really appreciate it. Really appreciate it. So look, we got Melbourne, Brisbane, Sydney, which is awesome. And look, because this session is very interactive, we really want to know your question because Manpreet and I can keep talking, and we might think that we have actually tried to add value, but we really want to add value for you. So if you can put in your questions in the chat as well, we'll try to answer them. Yes, there is a slide pack that we have. Manpreet will quickly cover what budget means. Then we together cover like what it means for the property investor. So that is the kind of agenda or the setup that we have. So who's feeling excited, by the way? So put in the chat or thumbs up if you are doing great. I know it's Thursday evening. You could have been out there and shopping, but maybe not with the inflation and whatnot. So put in the chat if you are excited. So let's bring it on. Yes, we have a lot of people there. Manpreet, no pressure, but at the same time, would love to hear your take. So we are really talking about decoding the budget 26, 27 and what it really means for the property investors. In general, this is a journal in chart, right? Like there's a disclaimer, please do not act on the back of this conversation alone. You need to talk to your advisors, your brokers, your financial planners, or not even your accountant. What Manpreet and I together are trying to do is to answer some questions of yours and also raise right amount of questions and right questions for you that you can take to your independent advisors that you're working with. So let's get going. So just very quickly, allow me to introduce Manpreet. Manpreet has been working in this industry for 20 years. Yeah, he doesn't look like that old. He's still very young. He got a good amount of experience behind him, and he has been helping almost like 800 families. So maybe Manpreet, talk through this your experience if you don't mind.
Look, guys, I've been running accounting business for almost 13 years, working in the industry for 20 years, which means I've actually seen 20 budgets came and went. I mean, there are tax changes announced every season. Well, nothing to panic. It's more about understanding how these changes impact your situation. So my goal for today should be to answer your questions, run through different scenarios, and then it's your job to ask me the right questions eventually if you're unclear about anything, and then eventually that will give you enough knowledge to take the right decisions for yourself.
Awesome.
So yeah.
So we are really talking about three main things, isn't it, in this budget? Of course, there are so many other things, but talk about specifically for property investors. What are the three questions we're really getting there, Manpreet?
Okay, so look, after decoding the budget or understanding the budget or reading the budget, I've actually broken it down into three different scenarios. Now, most of you would fall under these three different scenarios, which means you are either an existing property investor, or you're looking to buy your first home or first investment property, or you already have multiple investment properties under different structures, because budget did announce changes in the tax structures for trusts. So there are other tax changes in the budget, but we're going to cover the main three changes, which is essentially for an existing investor or someone who's looking to invest or who's got a property in the trust. And this is where you're trying to understand how these negative gearing, capital gain, and other changes do impact me. Or do they impact me right away? Or do they impact me down the line? What do I need to do?
So we are talking about
so what those three changes are. Now, three changes, three dates. Now, of course, as I said, there are multiple changes in the budget from a taxation point of view, but these three are the most key important changes. So the key changes are negative gearing, capital gain tax, and changes to how discretionary trusts were taxed. I'm going to sort of dive slightly deeper into each one of them. And then, of course, down the line, we'll look at the examples. Now, negative gearing, as most of you are property investors, you understand property investing. Negative gearing is when you have more expenses in the property and your income is lower. This is where you claim negative gearing on your assets. Now, what happens in that situation is, with this existing law, you can claim your negative gearing, which is the negative portion of the property, against your other income. So it offsets, it gives you a tax offset. But with the new legislative changes, You cannot claim negative gearing
Sorry,
on a
Manpreet,
property.
let's take a step back. Sorry, apologies. Like I'm not sure where the current understanding of the terminology is. So tell me, what do you mean by negative gearing to start with? Like when I buy a property, yes, there's some outgoings. Like I need to pay the interest, I need to pay some maintenance cost, and then there are some income as a rent. So tell me, so when you say cash flow, we're really talking about the delta of what I'm paying versus what I'm receiving. Is that right?
Yeah, let me give you an example. So let's say your rental income is $30,000 on an investment property, and your expenses are $40,000. And by expenses, what I mean is your interest, your rates, your council, your strata, your depreciation, all the expenses are 40,000. So you're $10,000 in negative. Now, as per existing rules, that $10,000 reduces your taxable income. Because it reduces your taxable income, you're eligible for a tax refund. But with these new legislative changes, that negative gearing will not reduce your taxable income. It's not that you have lost that negative gearing in the thin air. No, that loss will continue to be carried forward for future years until one of the two things happen. Until that property becomes positively geared and you can use up those losses that you've accumulated, or you're selling the property and you made profit, you can use the negative gearing losses against the capital gain that you've actually gained at the time of selling the property. So these two sort of have now interlinked.
So just to clarify, what you're saying is negative gearing, if I'm losing money today, I can carry forward my losses until I start making profits. In that case, for example, if I've for next 4 years, I've lost say 50K just because of negative cash flow or negative gearing. And
Yeah.
then once I start making money, I'm not paying any tax later on because it's offsetting the losses. Is that right?
Yes, that's right.
So
But let me bring
effectively,
you to the grandfathering as well.
so
That
effectively,
only applies to, yes, sorry, go ahead.
sorry. So, okay, I'll probably clarify this thing. So, okay, let's talk about the first thing, that the property was actually bought before. So, I'm already an existing investor. Does it changes to me? Does that, whatever you're going to say, does it matter to me? Like about getting
No,
negative
it
gearing?
doesn't. That's why they keep using this word grandfathering of assets, grandfathering of law. So if you already own a property before the budget announcement date, those properties are exempt under that new legislation, which means you can continue to claim negative gearing on those assets um,
Okay,
until any further changes comes in.
okay. So, for those who are buying now, I'm talking about those new investors coming in, or not new investors, but new properties that I'm acquiring now. If I acquire some losses, I'm just not getting immediate benefit. It just gets logged into the property until I start making profit or when I sell the property. So effectively, negative gearing is there. It's just the timing has just shifted out. Is that right?
So yes, you're right. Timing has shifted. So anyone who already owns a property, however, if you buy a brand new property, even post budget announcement date, even if you buy the right moment or next year, whenever, as long as it's a brand new property, the definition of brand new property is it's never been used before, you are still eligible to claim negative gearing benefits.
Okay.
So
So there are so many caveats, as you can appreciate, audience. So apologies because it took me a while as well. So by the way, I'm just trying to be a curious person asking questions on your behalf, and there's some curiosity for a valid reason as well. So what we're really talking about is if somebody's buying a property, it's a brand new property, nothing has changed for you. Is that right? If it's a brand new
yes.
property,
Yes.
in regards to
And
negative gearing.
that applies to negative gearing and capital gain legislation. Nothing changes for if you're buying a brand new property.
Beautiful. So now I'm talking about established property, which I'm about to buy. Negative gearing is there. It's just that it has shifted the timeline. It doesn't appear straight away in the same year. And also, Manpreet, if you can clarify, because I also heard that it will not offset my wage, like my annual PAYG, but it can offset my positive income from other properties. Is that right? So it's not really bound by the property. It has to be seen over the portfolio.
Yes. So if you are a property investor and you got a negatively geared property and you also got a positively geared property, you can offset the negative gearing against the positive gearing. What I mean by positive gearing is completely opposite than negative gearing, which means if you got a property where expenses are less than your income, so you got positive income from that asset, and then you got a negative income from one asset, you can actually offset the negative against positive. Now, however, if your positive is more than negative, you will be paying tax at your marginal tax rate. However, if your negative is more than your positive, the excess negative needs to be carried forward as losses for future years.
Beautiful. So it's something similar to what we actually were talking about in the trust structure, because that's typically happens, right? Like you carry the losses until you make it, and then you.
Trust.
I mean, I know there are similarities, but there's a bit of element of similarity there. Manpreet.
That's right. Trust structures cannot pass on the losses.
Okay.
So you can hear me?
Cool. So it's not too bad. Like the
Trust
whole.
structures cannot pass on the losses.
Yeah.
Yes.
So what I'm hearing from you about negative gearing alone, it's not too bad. Grandfathering is happening, still available for new build. For existing property, it can offset your other properties as well. If not, it can just carry forward. So this is what's your take? Like it could have been worse, right? Like it's not really too much of a sky is falling kind of a scenario. Is that right?
It's not. It's not. I mean, look, of course, there was a lot of ambiguity around what's going to happen. Is the whole property market's going to shift? Everything's the sky's going to fall, or whatever's going to happen. But from where I see things, and this has happened year over year. We had interest rate changes. We have budget announcement. Now, anything that was ambiguous in the environment is completely gone. So we know what the changes are. We know the interest rate have already changed. The budget has been announced. I think people can actually make more calculative and certain decisions as to what's the right strategy for them, rather than just still anticipating what's going to change.
Sure, sure. Like there's some questions on the chat. I'll get back to them on later on. Let's talk about the second change. We are talking about capital gain tax. Let me know what is it? What's happening, Manpreet?
Okay. So capital gain tax, let me just quickly give you an example of what capital gain tax is for those who are not aware of this. Capital gain tax is basically the tax that you pay on the capital increase of your asset. Now, that asset could be a property, shares, or any kind of asset. When you buy an asset, when you sell an asset, any increment in that value of the asset is basically capital gain. And on that capital gain, you pay capital gain tax. Now, as per current legislation, if you have held an asset for more than 12 months, your capital gain tax is discounted by 50%, or your capital gain amount is discounted by 50%. By example, you bought a property for 600,000 4 years ago, and today you're selling a property for 800,000. You made a capital gain of $200,000. Now that $200,000 capital gain is taxable in your income at your marginal tax rate. Because you held the property for more than 12 months, that capital gain gets 50% discount, which means that $200,000 gain is now reduced down to 100K with a 50% discount. That 100,000 is added to your marginal tax when you do your tax return, and that's when you taxed at that $100,000. With the new changes, with the new legislation, that 50% capital gain tax discount has been sort of abolished, not completely, it's been abolished. Any properties, okay, so let me break it down into two categories. So this legislation will come in, this has no sort of a barrier date in terms of pre-budget or post-budget. This is a legislative announcement on a specific date that will come into play, which means any properties that you own now, prior to budget, post the budget, any capital gain that you accrue on those properties until 30th of June 2027, that will still get 50% discount. After 30th of June 27, which means 1st of July 27, you will not get 50% discount. However, these properties will tax based on indexation. Now, what indexation is your CPI, which is your inflation rate every year, which RBA publishes every year, and ATO has its own formula on dictating what the indexation rate from a taxation purposes is. So post 1st of July 2027, any gain that your property makes, that will be indexed. Your gains are not indexed, your cost base is indexed. What I mean by that is, let's say you bought a property for 600,000 on 1st of July 2027, and you're selling it after 5 years. If the CPI rate indexation is 3%, if the inflation rate is 3% every year, your cost base has gone up by 15% in 5 years. And then your gain is automatically adjusted at the time when you sell it.
So what I'm hearing from you is that the longer you hold the property, you're letting indexation or the CPI or inflation, because indexation is to the CPI, right? And on
Yes.
average, the range from RBA, what they're targeting is 2 to 3%. So let's say middle point of 2.5. What if they successfully do it? Of course, inflation could be more. Like last year, what we saw, even going to the heights of 7.3%. So what we are hearing from you is that if the cost of living, as in the inflation cost, is going up, they are saying, hey, I bought a property for $1 million. In 5 years, based on the cost of inflation, the property is sitting at about 1.2, and now I'm selling at 1.4. Then my capital gain that I need to pay for is not on 1.4 minus 1, it's actually 1.4 minus 1.2, because 1.2 was the inflation
Exactly.
adjusted number, and I sold it for 1.4. And also, remembering the previous talk that we had about
Yes.
negative gearing, that if there were some losses accrued all the way, then I need to reduce those losses as well. Maybe it cost me 50 grand to hold the property for the whole entire life. Now I'm actually paying capital gain tax on 150K. Is that understanding correct? Merging the two concepts?
That's perfectly correct. And for those who are a long-term investors, now people think, oh, because CGT discount has been abolished, this is going to be too much tax or too much cost implication for an investor. Actually not. If you look at the CPI over a longer term, this could actually yield a better tax outcome for you if you're going to hold a property, say, for 20, 30 years and sell it. Because indexation will give you way better result than the CPI, than 50% capital gain tax discount. But let me sort of dive deeper into a little bit more on the capital gain tax. Now, people may have question around, I own a property now already, which I bought 3 years ago, which I'm not planning to sell it. I'll probably sell it after 10 years. How the capital gain tax will work? So any gains that you've been accruing until 30th of June, that will stay as it is on a 50% capital gain tax discount. So the important crucial factor for everyone who already owns an investment property, and this is it's a must do for everyone. On 30th of June 2027, you must get your property valued, because that's a line in the sand that will determine what's the value that will trigger 50% discount, the gains that will have 50% discounted value on the taxation, even whenever you decide to sell it. Any gains beyond that, that will set a benchmark for your cost base on that date. The
Got it.
value, it's not just for 50% tax discount. So you bought a property 5 years ago for 600,000. The value at 30th of June 2027 is say 900,000. That's your cost base of that property,
Sure.
not just for 50% discount. The CPI will apply on 900,000 beyond that.
Sure. So again, I'm just rephrasing it again. Yeah. So what I'm hearing from you, Manpreet, is that until 1st of July 2027, or say 30th of June 2027, we have consistently the same rule base of 50% capital gain tax discount,
For everyone.
irrespective of old, new, bought before, bought after 12th of May, it doesn't matter. Until that day, everything is CGT 50% discount. But post that date, even if I sell it or not, it is going to change the methodology of indexation base. And I think also there's a rule that has to be a minimum 30%, which I'll let you clarify later on.
Yes.
So what I'm hearing from you is that because the change of methodology is happening on that date, you are recommending people to start planning for getting a valuation for all of existing property as or close to that date, so that it becomes a basis for us to go to the ATO and say, hey, my growth, actually, most of the growth happened during that holding period until 27. So I should be treated with that methodology. And after that, it becomes indexation. And if I don't have that report from a valid valuer or authoritative body, then ATO will assume the whole growth happened as a linear lane, which is not likely because what
It's
we
a
saw
proportional
happening in
method.
the COVID years was a lot more than the next phase that what we're going to see. Is that what you're saying, Manpreet?
Yes, so that's right. So it you will adopt. Of course, they are going to release a legislation on how the valuation adjustments will happen over a linear cycle. There's this one exclusion, however, on capital gain tax changes. If you're buying a new property, regardless, you bought it pre-budget date, you're buying it now, you're buying it till 30th of June 2027, you buy it even after. These capital gain tax discount changes does not apply to your asset if it's a brand new property. You actually have an advantage. The advantage is if you're buying a new property and whenever you decide to sell it, you can actually decide if you want to use a 50% discount method or if you want to use an indexation method. Whichever gives you a better tax outcome, you can actually use that method. So for a new property, this could be a benefit. However, an investor should account for one thing. Newer properties does come at a premium. So over a long term, what the pros and cons are, this is where you need to do your modeling right from the beginning.
Beautiful. No, this is great, great. And look, there's some questions as well. I'll let you go and attend later on, if that's okay. Tell me about the third element, discretionary trust, 30% minimum tax. What is that, Manpreet?
Okay, for the third element, first thing I would like to sort of make an announcement. This is still a consultation paper. Now, as per my experience over the consultation papers released in the budget, there's always subjectivity to changes. Why? Because there's a lot of clarification that they need from experts, consultancy firms, tax department, and not only that, when there are consultancy papers in announcements, if there is any changes in uh, political party or another government coming into play, these may are subject to substantially change. But however, let's touch on that exactly what that is. Family trust has been a very, very popular structure over the years for businesses, property investors, asset holding entities, and there was huge tax benefits for family trust because you can literally distribute any profits, any gains from the trust to the lowest tax yielding beneficiaries. You can park the money into corporate bucket beneficiaries by reducing the tax outcome substantially, which always gave a much unfairer advantage to those who can hold assets under the trust. Now, with the new legislation, which will come into play from 1st of July 2028, so we still got a lot of time. Trust have now a family trust must pay a 30% mandatory tax on any kind of income, which is income from business, income from rental, investments, or even capital gain tax, which means discounts which they applied on individuals, 30% minimum tax on capital gains, that is still applicable on trust. So trust must pay 30% tax on any income yielded within that structure. Now, this is only for family trust. There are other trust structures which are completely excluded from this law.
Okay, so just taking a step back and from my non-accounting hat, if that's okay, Manpreet. So what I'm hearing from you is in the past, so many people were using trust structure for, of course, multiple reasons and valid reasons. A, asset protection, borrowing capacity enhancement, and also passing the income to the low tax bracket people. For example, passing the funds to 18-year-old, though the money goes in the parents' pocket, but they were passing to the kids because then the lower tax bracket. So they said, okay, rather than when I'm taking negative gearing, I take it my share. It's positive gearing, I pass it to my kid because that's where I take the advantage of discretion. But now what I'm hearing from you is that ATO have put the senses out there and said like, hey, it's not a loophole that you want to go and tap into. Every trust has to pay 30% minimum. Am I hearing you right?
You're correct. You're absolutely right. The trust has been an amazing tax strategy vehicle for most advisors, accounting firm, tax planning, consultancy firms, because the tax savings were tremendous, huge when it comes to using family trust structures, even just for asset protection point of view. Now, with these changes, the impact sort of brings everyone to a very level playing field, which means these trusts who are already holding assets, different types of assets, they need to either restructure, move the assets across. Of course, there's a lot of announcements and clarification yet to come on this whole trust changes, but this is gonna be the most complex change ever, which will bring a lot of transition in the industry.
Beautiful. And that starts from 1st of July 2028, so it gives you 2 years.
It gives you, so basically one thing, anyone who already owns property in a trust, don't do anything. Wait for exact legislations to arrive or more clarification on this, because you will still get 3 years to restructure your trust. When I say restructure your trust, there will be opportunity to restructure your family trust into a fixed unit trust or a unit trust or a hybrid trust based on your trust deed, of course. So don't do anything if you already own a property in a trust, because these changes are not applicable until 1st of July 2028.
Beautiful, beautiful. Look, there are quite a few questions who needs your time. So why don't we just go through the slide pack very quickly, so that
Sure.
you might be the questions might be hidden already, or you already answered them. And I would really encourage you to go back to those questions if that's okay. And if this public, I mean, it's if you think there's a question that should be answered for all, by all means you can speak in the camera as well. So let's talk through your next slide, what you're really talking about. So if you already own, so maybe you already covered it. Maybe I'll be very happy to be guided by you.
Yes. So look, I think that's what I was going to say. We've covered most of the conversation, so I'll quickly walk through, because this will actually give people. I know a lot of questions will be answered when I go through the next 4 slides, because these three type of people that sort of created as an example, people can relate to it. So first person is Sarah, who already owns a property, investment property, prior to the budget release date. Good news for you is, because you own before the date, the grandfathered rules apply to you to the life of the property. So there is no change. You don't need to essentially do anything. You're completely protected. However, if you decide to buy any more properties, that will put you in a different situation. Let's move on.
Cool. So that's where the grandfathering is happening for the life of the property, but the capital gain tax will be changing for everyone from 1st of July 2027.
Yes.
Awesome. So that was Sarah, who was trying to get into. Now this is James, 50%
James.
discount.
Now, James is a person who is a full-time income earner who's looking to buy his investment property, and he's contemplating a decision between, should I buy a new property or should I buy an old property? Because the budget date has already passed. Now he needs to make a decision. So if he buys a new property, he would get 50% discount, and he will get indexation. So he get to use one of the two options when he sells the property. He can still claim negative gearing benefits. He can still claim depreciation benefits. However, he needs to take into consideration what premium he needs to pay buying a new property. However, if he buys an old property, he will lose on those benefits that we've discussed prior.
Awesome. Cool. And then comes the third question, or third family.
Now, the third family is, I guess, sorry, I think we missed a slide
No,
there.
this is still talking about the CGT, sorry.
Okay, yes, sorry. So of course, in James' situation, old rules will apply if he buys a new property. So this is the thing. Old rules will apply if you buy a new property. New rules will apply if you buy an old property. So just remember those two things. New rules, old property. Old rules, new property.
Okay. I hope people are taking notes, because certainly I should be taking notes as well. So cool.
Look, I'll be happy to walk through the questions at the end, and go through the scenarios eventually.
Sure, cool. No, sounds good. Now we are talking about trust. That's Patel's family question.
So now Pat's family is someone who has multiple investment properties, who've got other kind of assets in the family trust. They've got family trust, they've got a beneficiary, they've got a full-time income earning person in the family, and they've got a person who doesn't earn an income, and they've got a bucket beneficiary. Now, some people may relate to this situation. So what happened in the old structure, old situation is, a family trust is able to distribute big chunk of asset allocation and not asset allocation, income allocation from those assets held under the trust to someone who's earning very less income, essentially reducing the average tax down to 10% on that person's income, and then distributing a big chunk of remaining benefits to a bucket beneficiary, which is a corporate beneficiary under the trust, essentially paying only 30% tax. Under the new rules, which is a big kicker for anyone who has a family trust and has a bucket beneficiary, now the trust will be paying 30% mandatory tax on all the income. If that income is distributed to an individual beneficiary can claim offset of the 30% taxes paid by the trust to an extent only on which they are taxable. So if someone is given $40,000 distribution from the trust has already paid 30% tax on that. Now, someone who only has a $40,000 income, they're only liable to pay $4,000 tax. So because the trust already paid 30% tax, the difference that trust paid extra, they can't claim it. So that's lost. That's one major loss at the trust level. Second, the biggest bummer is corporate beneficiaries. It's a double taxation. Corporate beneficiary or a bucket companies cannot claim any offset of that 30% tax paid by the trust. So trust pays 30%, distributes the money to the company. Company pays another 25 to 30% tax. So it's a double taxation. It's non-refundable, non-rebatable offset.
Sure. So that's when we're talking about beneficiaries, trustee, that means the person is already playing big already. So uh, I know there's loss and maybe more of a revenue for ATO, but nevertheless, the rules one should know beforehand before they really get into this kind of a structure, isn't it? So it's not a really
Yes,
afterthought. It has to be structured beforehand before making any decisions.
look, yes and no. And this is where I want to emphasize on the importance of strategy and right modeling and advice. I work with a lot of clients who probably only have one property in a trust. Trust is not, it's not a bad news for people who have trust. It's actually a good news for those who actually have trust. Because look, if you have only two beneficiaries who are individual beneficiaries who are already paying more than 30% marginal tax rate, and you've set up the trust for asset protection. Your asset protection is still in play. You can still claim those 30% tax offsets that the trust pays because you're distributing to individual beneficiaries. If your trust is already positively geared, because negative gearing, you can't claim it on your personal name anyways. Same for the trust. So trust is not a loss proposition. Trust is a loss proposition for those who are distributing to a corporate beneficiary. It's not a loss proposition. They'll just be paying slightly higher tax, but your assets are still protected. You still have other eligibilities.
Yeah. But look, at a very high level, we shouldn't be investing for the tax strategy. We should be investing for the wealth strategy, and tax is part of it. Would you agree, Manpreet, on that?
Or wealth strategies, exactly. Tax strategy, wealth strategy, and asset protection. These needs to go hand in hand.
Yeah, and the primary focus should be wealth creation rather than just trying to reduce the tax and getting bombarded with the worries of what budget has to offer in this version versus what they might offer in next couple of years or few years. Regulatory risk is there. We need to be mindful of all the risks that can go wrong, be protected, have that kind of buffers in place, know what can go wrong, what can go right, and that's what is all about investing in a right way, is it? Right? So let's move
Exactly.
forward.
The budget is not announcing anything for the next 4 years now.
I hope so. I hope so. Look, the key thing is, to your point earlier, now we are over with all the changes which should be coming, right? If at all, it will be only better, like in the sense that there might be some pushback by the lobbies and whatnot. It has already seen what could go different, and it has given a bit of stability, I would argue, because lots of people I know, lots of people are hanging tight, thinking that, hey, let me see what budget has to offer, and then we'll take a call. So we'll talk about that in a moment, like what it means for the property investors who are about to get in the property or already hold a property. So, but let's get into the next phase, which is your traffic light analysis of the budget, Manpreet. So I'll ask one question at a time. Tell me why you think it's green or red or orange, yeah? So my first question is, what do you think if you already own a home? What happens?
No change. You're in a green scenario there's nothing has changed. You're still eligible for all the first home exemptions, your primary place of resident exemptions, your 6-year legislation rule, you still fall under that. So if you already own your primary place of residence, congratulations, there's no change for you.
Beautiful. How about if I'm only an investor and I bought a property before the evening of the budget?
Same thing. Congratulations to you as well. You're completely protected. This is where grandfathering of laws comes in play. There's no change for you.
Beautiful. And if I'm about to buy an established home, so the key thing is established, not a new home. I'm talking about established home. What happens now?
Now, if you're planning to buy an established property, then of course the costs are higher because all these changes that have come into existence with this new budget, they all apply to you, which is changes to the negative gearings that we've discussed. You can't claim those negative gearing benefits. You can't claim those 50% CGT discounts. And on top of that, if you're a short-term investors, it's going to have substantially higher cost to you.
Sure. Let me stay tight because I'm going to present you some contrarian view on that, Manpreet. So we will talk about this again, what happens. So next, moving on, if you're about to buy a new home, new build, adding a volume, adding a supply to the houses, that's the definition of new build. Maybe very quickly, what's the definition of new build?
So the definition of, so I think a lot of people may get this confusing argument, but what new build is? New build is not new build if it's a property that is just renovated. If you demolished a house and build a new house on that, that's not a new build, as per the new build definition of this budget. If you build a granny, that's not a new build. New build is one of the two categories. Either you build a brand new house on a land which did not had a house before. You demolished a property, but if you demolished one house and you build two houses, three houses, they will all be considered as new houses because you added the number of houses. And of course, new build apartments are also new build. Anything else is pretty much not a new build. However, commercial properties are not impacted by this law.
Beautiful. So what happens to them for someone who's adding a new or buying a new build?
Now, if you're buying a new build, of course, most of the things are grandfather. You are largely unchanged. So you still have negative gearing benefits. You'll still have 50% capital gain tax discount eligibility. And on top of that, you'll have 30% on or 30% the indexation clause applicable to you.
Beautiful. And what about family trust, especially with the bucket company?
Now, this is where the complexities come in. And this is where you need a proper modeling. This needs to be taken care very specifically based on your situation as a family. And you need to consider what's short-term versus long-term reward for you of holding a property in a trust structures. Or you should consider restructuring the trust once the legislation is more clear. What's the cost of restructuring versus what's the cost of not restructuring, continue to holding the properties in the same structure over a longer period of time. So there needs to be a lot of analysis and numbers needs to be done around that. But of course, we've got a plenty of time to do that. So don't rush into anything.
And I think you also made a good point that if all the members in the family trust are of equal earning capacity as an average, not average, I mean similar, or not even similar, as long as they're
Beyond 30%.
beyond 30% their tax bracket margin is, there's no difference whatsoever.
Yes.
Beautiful. We have not talked about something which is very close to many people, and that is SMSF, buying property in self-managed super fund. What's going on over there, Manpreet?
Look, I think SMSF market is going to have a lot of boom. We've seen a lot of boom in SMSF
Sorry, before
market.
we play, let's clarify what changes are happening there in super fund.
Firstly, no changes are happening in super fund, which zero changes, zero capital gain tax changes, zero negative gearing changes, zero indexation changes. So it was already a premium structure when it comes to buying and holding properties over a long term. If you're really buying for a long term in terms of long enough to retire, SMSF was already an important structure. An amazing structure that you could actually buy a long-term investment. Now it has become even more premium and better structure as opposed to holding in a company, family trust, or any other trust structure, even on your personal name. Because the benefits that you get over a longer period of time are make or break in terms of your cash flow strategy in when you retire.
So investing in super is very complex, though.
It's yes, it's complex, but if you have a right team, it's not complex.
So allow me to plug in the advertisement for my own masterclass that we run together with from someone from AceBiz, Manpreet. What we run is a masterclass on investing in super, and the next one is happening on 27th of May, which is a couple of weeks. So anyone who's interested to find out like how to think about property investing in super, by all means put in the chat SMSF. My team will follow up and send you the registration for that. So put the word SMSF. If you like to learn about property investing in super, how it happens, what really needs consideration need to be made, because it's complex, it's not straightforward. But because of all the reasons what Manpreet is saying, like things have changed here and there and there, but SMSF has not been changed. So that's really something. Like Manpreet, you're already saying that it's actually a very good structure. But on top of it, if we really bring everything down, relatively speaking, the super stands out without when there's no change there. Would you agree?
Completely. Look, in a longer term, when you look at these structures and 30% mandatory taxes and indexation and compulsory tax on trust, super essentially pays zero tax, 0% tax if you follow the right strategy in super. When I say zero tax on the capital gains that you make in super.
No, beautiful, beautiful. And I think it's not on your slide, but what happens to the commercial property? Because we are buying commercial properties as well. What happens to them? Would you have any insights on that? Like any changes happening
Well,
in?
commercial properties are largely unchanged. Of course, the definition of commercial property needs to be met.
Yeah, beautiful,
So
beautiful. So thank you so much for your rate card here. Seems like there are more greens than the reds, and I would actually argue red is not that red. If you do,
it's
if
not
you
that red. That's why I mentioned that. If you're buying a new property, consider the premium that you pay. But however, of course, you need to keep the color combination there, right? So
no, beautiful, beautiful. Let's move on to the next one. What's happening for Sarah? You know, like we talked about Sarah in your scenario. What's happening?
look, Sarah was worried for nothing. I mean, she was waiting for budget as if a lot of things gonna change. But I guess Sarah's in the most amazing situation after these announcements because she already owns a property, already had grandfathered existing legislations and rules, so nothing changes for her. So she has $0 impact on her tax situation.
I'll probably argue actually it's a good news for Sarah because
That's what I'm saying. Big news for Sarah for two reasons. Of course, that is something on your forte that you will explain because you're the property strategist who can tell why it's going to be important for Sarah to actually be in a winning situation.
no, for sure, happy to. So because if she sells this property now and then replace with something else, she will lose the grandfathering on the property. So grandfathering is not on the investor, it's on the investor holding that specific property. So even if this property might be underperforming a bit to her liking, it still makes sense for her to keep holding it for longer because of the benefit that she's holding or enjoying on this negative gearing, thanks to the grandfathering that you just explained. Now, what also it means is that there will be less properties in the market because lots of Sarahs out there, for the same reason, will not be selling the property in the market. So the modeling, I would argue, the treasury what they had in their announcement that there's a rollover of the funds, like of the property in 4 or 5 years, is probably not true anymore with that assumption that Sarah will not be inclined to sell. So maybe from the chat or on the group audience, if you have an investment property, would you let go of that negative gearing because it has been grandfathered? So put in the chat, yes, you would let go. So yes, you'll sell it. No, if you don't, if you won't. So because there's a huge dollar figure attached to it, right? So Varun says, of course not, he
I
will not
mean,
sell,
that's
right?
where the
So,
government completely got it wrong.
so the modeling has been, like it's to me, I have been spending a lot of time with the media commentators and doing this thing like on media interviews. And the biggest thing that I actually found was that the assumptions, the treasury what they made was true for the time that they made the decision without really accounting that what market will react to it once those changes are made. So the key thing is Sarah is worried for no reason, but probably she will actually enjoy more of the demand supply matrix around it. So moving on, let's talk about the second example that you had for James. he is, what do you think? What happens?
Look, we've already spoken about James. Again, he's considering if he should buy an established house versus a new property, which will give him negative gearing benefits. Again, going back to your opinion on my red light there, he needs to weigh the market premium on resale and market premiums on buying the new property. And this is where he needs to take a proper advice, because over a longer period of time, he may still be benefited owning an existing property because he did not pay a premium on buying a new house. But of course, when we're looking at cost benefit analysis from a taxation point of view, yes, new properties do win because we're talking about tax. But from a property strategy point of view, of course, opinions might differ.
Yeah, let's talk about it in a bit more detail because I got a bit more detailed numbers around it. And what about the Patels?
Now, of course, because they were distributing, now Patels were distributing a lot of benefits to low-income family members, bucket beneficiaries. They were paying only $29,000 tax on 145K distribution from the trust. Now, the trust has property and other assets. Now, this is, I've not refined a full spreadsheet on the slide here, but on a high level, they had $145,000 income in the trust, which was distributed to the low income earning beneficiaries and bucket company. They were paying only 29,000 roughly in taxes. Because of this new legislation where the trust has to pay that mandatory 30% tax, and the corporate bucket company will also have to pay additional tax on that, their taxes have jumped from 29 to 43. That's the biggest jump that they're going to have, regardless of what else they can do with the situation. Now they probably consider restructuring, but the tax situation is less likely to change for them.
So this is something that everyone listening to this call should be talking to their accountant to work it out what the options are. But what I'm hearing from you is that do not rush into it. You got a good window when things get legislated and finalized, because there's a lot of things going around it. Like if restructure is allowed, what happens with the state law, the stamp duty and whatnot. So all I'll probably say is let's wait until we have the whole clarity. There's no need to rush into doing anything. Would that be a fair statement, Manpreet?
Yeah, I would like to add one thing there. The reason why I'm emphasizing on the fact don't rush into doing anything if you own an asset in the trust. Because if you do anything now, change the structure, sell the property, transfer the property, you're looking at three implications. There's definitely capital gain tax implication if you move the property across. There's definitely a stamp duty implication, and there's an essential restructuring cost. Don't do anything at the moment.
Beautiful. Let's talk about your general overtake on the take on the budget. So you classified into no more reds, which is great to see. So it's all green and amber. So talk me through this slide, please.
Look, my general opinion is that I had a very controversial opinion on the overall budget. Not that what it does, but the government had it completely wrong. They thought that by bringing in these changes will essentially collect more tax to cover the deficit in the budget. But I think people are going to be holding on to their assets, their dear assets, long enough since it is all grandfathered. So there is less transactions happening in the market, which means probably those CGT changes that they brought on which they're going to collect the tax. They're probably never going to collect the tax because I will never sell my property now. And because I'm not selling my property, good luck getting a capital gain tax from me. And good luck getting stamp duty in the market because there's less transactions happening. But again, overall, since the budget is announced, it's overall a good budget. Look, it's from an investor point of view. Anyone who owned multi-million-dollar portfolio, yes, it might be something to see for you guys. But anyone who is a new investor in that starting phase of investment, who already has an investment or looking to invest, who got a couple of properties, I think it's a level playing field for you because now you have an advantage over everyone who was out able to go in the market with their multiple trust structures and buy assets.
No, very well said. Very well said. Look, I have a multiple property portfolio, as lots of people know. I'm actually very happy because the long-term fundamentals have actually become stronger now. Because it's really about the fundamental supply and demand, and I'll talk about that in a moment. So even, and to your point, you're absolutely right, absolutely right, saying that it's a leveling field for someone who's coming in, provided they take decisions based on the data and the logic and the structure and the strategy, rather than the whims that, hey, my friend has bought it, that's why I'm going to buy there. So as long as it becomes a more of an individual strategic approach to buy properties and buying for the long term, it certainly makes a lot of sense. So thanks for you sharing that insight. Let's very quickly look at what to do now moving forward, Manpreet.
Okay, so four things that you need to do now. I think I've just got a date wrong on the first one there. Uh, as I mentioned previously, if you already own an investment property, make sure you get a valuation of that property. Just change that date to 30th of June 2027. That's your line of your cost base or your gains incurred until that date on which you'll claim 50% tax discount, or that will become your cost base for
Yeah, but
future
that's still got
CPI.
13, 14 months. So it's not now, but
It's
absolutely.
not now. It's not now. It's just a checklist for you to keep that these are the things that must happen if you want to add it to your calendar for that date. Because uh, when, I'll tell you one thing, because all the properties, all the investment properties will be valued at 30th of June 2026 or 2027. The values are going to be busy. So you have to make sure that you make those arrangements well in time, because we only have enough property values in, I don't know, so many investment properties. And of course, if you have a trust, review your trust structure. Don't change, sell, transfer anything. Do a proper modeling, cost analysis, and look at your rollover options. If you're going to restructure, if you're going to roll over, look at those structuring options now so you can plan in timely fashion. And of course, third most important thing, do not rush. Take a big pause here. Nothing is law yet. If you take any decision now, this could be an irreversible decision for you. Don't sell, don't restructure, just plan and model before you buy. Plan, don't stop buying. If you are a property investor, you are looking to buy, don't take a decision based on the budget that, okay, how it's going to happen or what's going to happen, or is it changes just applicable to me? It's across the board. So model properly before you buy, establish versus new build, what kind of structure, all of that. And again, five things to remember. If you already own the property, you're well protected. New builds are favorable assets from a taxation point of view. Family groups need distribution review and get your values done on 1st of July or before 1st of July, and wait for the law. Don't preempt. Now, I guess from here, this is my part of the conversation, talking you guys through the budget. Of course, we're going to go through the questions, but I would really like to hear Rusty's opinion as a property strategist, because he has been watching market closely. He's been working with tons of clients, helping tons of families who want to buy properties. So over to you, Rusty.
No, thank you so much. No, thank you. Really, really appreciate it. I know you're in Seoul. Please hang tight. There's a lot of questions waiting for you. I've been reading them and I'm like, okay, let Manpreet answer them. So please bring your questions. I'll probably take this conversation to the next level. It's like, okay, budget is there, all the news media, all the Facebook chats, all the, you know, everything is talking about budget and what really it means. I'm going to share with you moving forward very quickly what it means to the property investor. So very quickly, for those who doesn't know, I'm an author. I've written a book. Um, it's called The Property Wealth Blueprint. It's actually there are 5 copies that I'll be sharing with you today with 5 of you. I've been quoted in multiple media. We got some awards, and I've been awarded for the Community Award Services just to bring knowledge and deciphering, decoding the market, what it means. My background wise, I actually have like a few degrees behind me. They were on unrelated, but it makes a lot of sense now. So I'm an architect, allows me to look at the quality of the property from the design perspective. I got a data science degree, master's of computer science, and I've worked in the banking sector as an MBA and a CFA degree holder, working with Westpac and AMP Capital as a fund manager. Together with my wife, together we have 21 properties now. Value is in north of $15 million. And just sharing so that you know where I'm coming from and I'm sharing my knowledge behind it. We have actually helped, so we are an independent buyer's agent. So what it means is that we are independent. We are not really getting any commission from anyone. We are really helping you or people that we work with to build the strategy. What just Manpreet and I were talking about, that it has to be personalized. It has to be built for you based on your risk appetite, based on your family circumstances, based on your borrowing power, all of that. So we actually collated an independent team of mortgage brokers, accountants, like Manpreet that whom we were just listening to, and help them build a portfolio which is robust. Not thinking about the property, but a portfolio. We have bought more than 300 million worth plus of properties, which has gone up by $150 million. More importantly, I'm super proud, Rupali and I, we are a sponsor of 29 kids, sorry, 30. We just added one more kid recently. So we are sponsoring 30 kids education and a part school in Africa. So that really gets us going. And that's what I'll be going to talk about. So let's make it interactive. This is where I'm coming from. I'm here to share my knowledge, but only in knowledge. This is just my personal take. Please do not act on the knowledge alone here. It should raise questions in your mind to ask the right people. We are not selling anything. So would you pause? Now, the budget is there. I know lots of people on the sideline for too long waiting for the budget. Now, let's get to your fingers on the chart keyboard. Would you pause your investing right now? Would you, like, if you believe in property investing as a vehicle to build wealth, would you stop? Would you sell? Or would you add? Of course, if you are permitted, right? So put in the chat, there are 4 options. Yes, pause until things settle. I'm not sure what things you're talking about to settle. You'll pause. Put A. Put B, if I'm carrying on as planned. Whatever you are doing, you're continuing. If you are holding, you're holding. You're buying, you're selling, you're selling. C, now you're saying, hey, new build make a lot of sense. I'll be concentrating only on new builds. Or D, I have no idea. Nothing wrong with D. And I really appreciate you saying this because lots of people are still figuring it out. So that's okay. So put in the chat, if you are pausing until things settle down, put A, carrying you as on plan, whatever it was, because you have your strategy in place. The problem with the B is when people do not have the strategy. If you do not have your GPS to travel, you can't continue on the journey, right? Say only the new build, because that's a lot of media talking about, hey, because this negative gearing and capital gain tax and whatnot, it will be all available in the new build. Let's go and focus there. And by the way, there's depreciation as well. So it makes it easy to hold, right? So lots of people going that way. Nothing wrong with that, but let's decipher. So I'm seeing a lot of B and C and A. That's great. Okay, D as well. Good. So let me help you in the next 15-20 minutes. Then we'll open the floor for questions. Right? So first of all, what really we have seen in the negative gearing? This is as simple as, I can explain. Think of this as if the interest rate has gone up by, let's say, 0.9 to 1.5%. Like, let's say 4 to 6 rate hikes we have seen. That's all it means. So do not worry about anything. Assume your interest rate has gone up from whatever it was 6% to say 7% in a simple form. Again, I'm thinking from the strategic point of view, what it looks like. Negative gearing on average for the data that we could collect in financial year of 2023 was about $14,000. And 1.2 million properties were negatively geared in that year. So imagine how many properties could have been in the market had there been no grandfathering. So that was the thing lots of people, professionals in this industry, were putting their fingers crossed that what if they don't grandfather? And had there been grandfathering not there, it would have been a bloodbath. And because it hasn't happened, lots of people are cheering positive. Does it make sense? Because if you can't hold your portfolio, you'll be selling it. And because of the capital gain tax, people will be double taxed, like A, they have to sell it, B, there will be a lot of capital gain tax, right? But the thing is, because there's a lot of grandfathering, as you were discussing before, there will be less properties in the market now. Why listings will fail? Because if you are holding a property, you don't want to lose the grandfathering, isn't it? Lots of people said they won't, right? So listings will fail. So there has been some data, there has been some reports out there by the likes of CB and whatnot. What we are really saying is, as my screen got stuck, is it?
Yes, we are just seeing the hidden rate rise screen.
Oh, okay. Not sure what happened there.
You want to close it and open it again?
Bear with me.
Sure. No, thank you so much, everyone. Manpreet is trying to answer all the questions. We have noted down the questions as well. So we'll probably, in the end as well, we'll go through the questions if they are not answered. Yeah. Thanks, Manpreet.
Yeah, I'll try to cover as much as possible, guys. If I tend to miss anything, do just tag your questions, so I'll get a bottom notification. But of course, at the end, towards the end, we'll go through anything which is unanswered.
Sure.
Cool. No, thank you, Manpreet. Really, really appreciate it. So I think slide is back. All I'm saying is listings will fall. So the market, think about this market as a simple thing called supply demand, right? There has to be supply and there has to be people going to buy them. Now, existing property in particular, there will be less tendency for people to sell unless they really are cornered into selling. Until then, they will try to hold as long as possible. So because of that, listings will fall. So that means in the existing property market, people who believe in that kind of a market and the first home buyer, they will be competing for less number of properties in the market. So economics 101, if there's less supply and more people buying it, I'm not saying just the investor, because the investor might really think differently with the new information on the new build. But imagine the first home buyer with all the grants given to them, they are rushing only in the existing market because that's where they want to live, but there are less supply in the market. So what happens to the price? When supply is less, demand is more, what happens? Price goes up or down? Put in the chat, what do you think? Price goes up or down when there's limited supply and more demand building up, right? So that's where, because the supply is, listing is fall, and you all agreed that listing will come down, right? Now, we are really saying that what it would actually do, according to Treasury assumptions as well, the rent will increase less than $2 per week. Now that looks pretty small number, isn't it? Less than $2 per week. But I'm doing mathematical calculation. I'm saying, hey, 52 weeks in a year, we're really talking about $100 per year increase in your rental. What happens to the rent now? The Treasury themselves are saying rent will go up. So any person who's buying property today, let's be mindful, the cash flow might be very bad today and there's no negative gearing, totally get it. But with that rate of increase in your rental demand or the rental pricing, earlier it was used to take 5 to 6 years to become neutral and then positive. I think the way it is going, maybe 3 or 4 years now moving forward. Does it make sense? Now, SMSF, the standout of this budget is really we talked about negative gearing, can still offset everything what we know, 50% CGT discount, trust minimum takes, it doesn't apply to what we just talked about 30% because all is enveloped in or bucketed in that SMSF structure. So again, there's a SMSF masterclass on 27th of May, 7 p.m. For those who have not put in the chat group SMSF, please do so if you are keen to come along. Now, the gap between investing personally and investing through an SMSF on capital gains has gone from meaningful, it was meaningful earlier before, now it has become enormous. Because what this budget is saying, guys, short-term traders, please stop trading properties. Please stop buying for 2, 3 years, 4 years. If you are in for it, only be there if you are there for long term. That's what budget is saying. But for what we have been talking about advocating is that property investing is for the long term. That transaction cost is so high. Get in the market almost about 5%. Stamp duty, buyer's agent, lawyer's fees, building inspection, there's so much of fees. And then when you're selling it out, then again 2 to 3% for your sales agent. So all up, you're losing 8, 9% just to sell in and buy in, right? It makes sense for some category, for example, flipper, where they say, hey, I found a property under budget, distressed sale, let's go and buy it, renovate it and sell it after 1 year. They will be hammered because of all the changes we are talking about, because indexation means like CGT based on indexation, it only goes up by 3% on paper at most, right? Whereas earlier they were getting 50% discount. So now they are saying, do not do that. So those are the things. What really is making sense is that, okay, let's go and buy for the long term. That's why we are doing it, and SMSF is also for the long term. So it's a better marriage. Do you see that? SMS for the long term, properties for the long term. Now, really, what this budget, three rules textiles have changed, but it hasn't changed the fundamentals. I'm talking about the fundamentals. It's really fundamentals. It has changed three things. If you think about it, probably not. It's the migration. Still 340,000 people coming last year, right? Supply below target by 70,000 per year. So yes, rules have changed, but not the game. The fundamentals still the same. Building approvals, it has gone, it's the lowest in the decade. So we're not building enough homes that the new migrated people are actually requiring. Does it make sense? So the supply demand has not changed. What has changed is just the rules, which is really only saying, hey guys, please buy only for the long term. Don't worry about the short term. We are really adding 340,000 people. It's like almost the population of Canberra. That's a new city building up on an annual basis, right? We are not building anywhere near enough. And that's the data which I'm really trying to put it here, that what you see is 240K is required and we just built 170. So there's a gap of 70,000 and that's going for not consistently almost 4 or 5 years now. And there's no slowing down of this gap. So if you think about it, what we're really saying is there are more people coming in, we are not building enough homes, government or the budget, instead of solving the problem of the supply side, they're making it harder for people who are trying to do it. But again, not so much so, because they're still saying, government is saying, hey, I'm okay for the long-term investors, but not for the short-term traders, because that's really hyping the market. For the long-term investor, that's actually a great news. Would you agree? So because the fundamentals are the same, it would really push the market, on a higher side. Two things tightening the market further. Builders aren't getting projects because there's so much of red tape. Had I had any say, I would say, hey, bring down the approval cost. For anyone who's developing properties, the money and the energy and the, sweat goes in getting the approvals out and the big portion of the fees. So they should have been doing that, but rather they're giving all sort of supports like the first home government scheme. Can you believe just getting 5%, all these rules that we were just talking about, Manpreet and I, they only apply to the investor. But what they are doing with the first home buyers, they're saying, hey, if you have 5% of your money, you can go and buy property. Imagine 50K in your pocket, and then you can go and buy $1 million property. Earlier, until October last year, that was limited to only 50,000 people per year. Now, it's unlimited. If someone is single, they need only 2%. Imagine with the 20K in your back pocket, you can choose to go and buy a $1 million property. That doesn't make sense, So it really has become more of a political play rather than an economic play, what government has just done. So they are bringing more schemes left, right, center. Help to buy, stamp duty concessions. Government is saying, hey, we'll give you 40% equity. What they are trying to do, they're building the demand. Would I appreciate if somebody is not capable and they're buying it? Maybe not so much so, but we are in the market, we are in the industry where there are all sorts of people. So imagine again, if you're not building enough and there are more immigrants coming in, more first home owners, whether they can afford or not, they're buying in and even tapping the super to buy property. What do you think would happen to the property market? It becomes bloated, it goes up, isn't it? Our job as a responsible investor, as a responsible person to build wealth for the family, for the future, all you need to know that in the past, any property anyhow would make you money. Not anymore. It doesn't mean that property investing is out of favor altogether. It just means you have to be more selective. So let me know if it is making all sense right now. Give me a thumbs up if it's all making sense. If you want me to continue what I'm sharing here. All good? Give me a thumbs up. Cool. So the key thing is that tightening supply and government subsidized demand. Price can go in only one direction, right? Now what's really happening? At a very high level, at a very, very high level, What we're really saying here is that in metro, the yield is about 2.5 to 3.5%. So now we have to be very, very strategic. Lots of people think, hey, let's go buy in metro, the likes of Sydney, Melbourne, Perth, like people feel comfortable with the metro. But the reality is, all this removal of negative gearing, it is saying, hey, if you have enough deposits in your pocket that you can survive the negative gearing removal impact, then do whatever. But if you don't, if you fall in that average category, then we need to make sure the property you're going to buy, if not neutral, if not positive, should be at least close to getting neutral. So in that case, we need to really focus on the better yield than otherwise. And the better yield are typically can happen only two ways. One, we go and buy lower budget property. So rather than buying a $1.5, $2 million properties, you should be thinking about buying properties around 500K, 600K, 700K. Why? Because in that kind of budget, as a percentage, your yield is better. Does that make sense? Does anyone experience that? Like on $2 million property, you might get only 2%, 2.5% yield. But on a 600K property, you might get a yield of about 4.5, 4.6 kind of a number. Easily, right? So that's what one thing is saying. So rather than buying in metro, seems that my slide is not going through, so apologies. So instead of buying in metro, you should be considering buying property in regional area. That's one suggestion that comes out straight away, because the holding cost is material now, right? Second thing is, yes, there's a lot of new build benefit given when you can choose to go and get the benefit of negative gearing and the cost of holding, especially when the depreciation is also there. Now, with the research from so many publications and my own research, new build are typically in the fringes, means they are on the outside. Unless they're units, then they tend to get oversupplied. Like, as an example, in the heart of Melbourne, there was an 11% vacancy rate during the COVID years. Imagine 1 out of 9 properties was vacant in the COVID years, right? So vacancy can go and build up very quickly. So you should be thinking about independent homes where you have control. You can have the land value, you can add value as well if you want to. So be careful when you're really asking for a unit, first of all, right? So if you're not buying a unit, if you're buying a home as a landed property, as a house, then they are actually in the fringes. So new build, because of being located either as a unit or in the fringes, they are in the oversupplied market. So if one thing you can take out from here in this conversation, it is that it's all about supply and demand. So don't think what tax incentive is being given to you. Think about why you are thinking about buying property. Is it to minimize your tax, or is it really to make money, build wealth? If it's build wealth, then think what works for you. So building wealth happens when you're buying for capital growth. Of course, you can't buy every property for capital growth. You need to make sure that's the right balance between your cash flow holding power, because you don't want to just struggle holding the property in the anticipation of the growth in the future. So it has to be balanced based on your based on your borrowing power, based on your savings rate, based on your risk appetite. So based on the research, the annual capital growth long-term on established market is about 6 to 8% on average. And I'm talking about average for last 30, 40 years. Versus new build, they tend to grow very quickly in the first 2, 3 years, but then they slow down. And the average rate of growth is 3 to 5%, as per a lot of research, even done by PIPA and the banks as well. So with that in mind, if you really think about everything what we just talked about, 2 scenarios. One scenario, let's go and buy a 700K property as a unit, a new build, where you get all sorts of negative gearing benefit. And on the other hand, you have to pay, or you buy established property. Yes, the cost of holding is higher. Yes, you cannot take the negative gearing. But if you have other properties, you can offset that with other properties. If not, you can carry that loss for next few years until the rent catches up and makes it neutral. you are really just facing that cash flow issue rather than anything else. So this budget has not really been very detrimental. So we have actually come up through all the assumptions like, okay, let's say buy purchase a property of 700K and then acquisition costs and whatnot. Over the next 20 years, as you can see from this line here, the top line is really of established home. So if you're holding a property of $1 million, you would make, if you're buying a property of 700K and you hold it for 20 years, your money that you're going to build is 1.4 plus, but then you give capital gain tax. Your money that you're going to cash it out, net number is $1.034 million. Again, let me play with this again. Seems that my screen is getting frozen. So you are actually making 1.03, let's say $1 million from that investment. Whereas if you buy a Metro new unit, you're actually coming up with $408,000 or 600K almost, based on the indexation process used. Because you are in the new build, you are given a choice whether you want to take the 50% CGT tax or you want to take an indexation. So this is a choice given to you. So even in both scenarios, an established property in the long run is far better. Make sense? So if you're thinking about the long term, do not think about the cash flow alone. Think about the whole thing. Now, just so that you know where the numbers are. So this is the chart, like the data that what we see all the time. This is from 12 months to 30th of April. I just want you to focus on the last bit. So combined capital grew by 6.4%. That's the annual growth rate for the last 12 months ending 30th of April. This is the latest data. Whereas combined regional went by 13.0. So it's really more in our perception that we think investing in regional is risky. If you are thinking more from the long-term perspective, imagine if you hold this property for the next 5-6 years, the difference between 6.4 and 13.0 is a lot more bigger difference. Would you agree? Thanks to compounding. Similarly, that's just the capital growth. Now let's look at the rental yield. Rental yield is again much better on the regional areas. So combined capital gives the rental yield of 3.2, but combined regional is 4.7. But before we make this assumption, we are talking about the averages here. We are not buying the whole capital market. We are not going to buy the whole regional market. There are regional markets which can give you the yield of even 5.5, 5.6 as well. But we need to be mindful what it means if you buy a property more towards the cash flow, how it starts impacting the capital growth. So there has to be a modeling done. So the point I'm to make is that if everything makes sense, key note here I'm trying to convey to you is property investing is not out of favor anymore. It's still there. It's very much so. It's just the lazy investing that, hey, everyone is buying in Metro, let's go buy in Metro. That kind of investing is over. So if you are strategic about building wealth, that's what you need to be thinking about. Hey, how can I build a portfolio? Why you are doing it? Because the bottom line is long-term property wealth is still on the cards, because as long as you're strategic, as long as you are taking into account your personal numbers, the key thing is personality. Like, you need to know your risk. You need to know your savings rate, your borrowing power, not someone else. You need to have the right team to get that strategy in the personalization working for you. Getting the right broker, what sort of LMI, what sort of structure that your accountant can help you with. Then, because the negative gearing impact is taken off, it just means earlier we were saying, hey, only you have to have 3 to 6 months of buffer in your pocket. Now let's push it to say 12 months. So all you have to have a bigger buffer. So that means cash in your pocket is a lot more dearer now versus otherwise. So rather than thinking about 80% deposit, 80% LVR and 20% deposit, maybe you need to think differently now. Talk to your broker. Maybe have that 10% extra in your pocket by going for a route of paying LMI, if that makes sense. So you need to have buffer. Your money should be leveraged for you without really putting you at risk. But the key thing is one property is not going to make a difference. Well, maybe it does. It can make your lifestyle better, but it cannot change your lifestyle. For you to change your lifestyle, you need to think about building a robust portfolio suiting your capacity suiting your buffer, suiting your and what you aspire for, your aspirations. So that's what it is about. So if you have the clarity what you need to do, it's just a matter of fixing it up, because until now you can just buy any property and you still hope that it works. But now you can't buy just any property anymore. You have to build the portfolio to your liking, the way you should be doing it, right? So what we really do as we run other masterclass around it, like how you should be thinking strategically. So I will not really run through right now, but maybe Rupali can share the link for the masterclass there. So what we're really saying is that you need to think about your end goal and build it up from there. So this is the rare model that we have, R for review, A for aim, R for raise, E for enjoy. So you build up what your end goals are, then you work it out where you are, talk to your team, understand your risk, understand your savings plan, and then you build a portfolio. So that's what it is about. If you really need to know what it looks like, let's meet Sandy, IT professional, 280K in equity, 210 in cash, and he is just overwhelmed. He does not know what to do. He's unsure, playing the rat race. He goes to work, comes back, 5 days goes in a row like that. Saturday comes and goes, and then Sunday just chill out, and the Monday blues. Who knows what I'm talking about? It just goes so quick. But since we built a strategy for him, he was able to buy 4 properties. He has built equity of in excess of $775,000. More importantly, got clarity. Now let's have a look at the portfolio very quickly. First property in May 23, $512,000 off market. Value went up by 72% 3 years. So if you pick the right market, 72% 3 years. Who would like that, by the way, in the portfolio? Right? Second property, $386,000. We bought for, value now $615, 59% in 30 months. Third property, 22% 2 years. Fourth property. So as you can see, he has been building a portfolio bit by bit. That's what it is about. You need to know your rules. Again, it's not a random. 4 good-looking properties, and he was able to build equity of $775,000. So this is what it's about. So now for those who are thinking that, hey, what should I do now? Because that's a story from the past. Sarah, 47 years old, 2 kids, 1 mortgage, 1 investment property. Now the question is, what she should do? What do you think? Path A, react to the news. What's really happening in the news, what the budget is saying, and then react to it. Sell, wait, restructure in a hurry, listen to the loudest voice, because that's going to happen. There are media which will talk about the fear mongering. That's how media sells, news sells. Or path B. So put in the chat, what do you think? Path A, where she should react to the news, or what B, what Manpreet was saying, step back, think long term, zoom out, trust the structure, and decide based on the next 15 years, not 15 days. Because what Sarah did, what she did was she didn't decide based on the budget. She decided based on something her grandmother used to say. And that was, you don't plant a tree for tomorrow's shade. Whatever you need to do is you have to think for the long term, right? So you have to pick right strategy, the right things for you, because here's what 15 years look like. Lots of people think about the budget, the noise, what's going to happen. Hey, should I get valuation? What happens with negative cash flow? But the reality is, if you're really up for portfolio and building wealth for your family and for yourself to enjoy the life you really deserve, you need to think really, really, really long term. So put in the chat, long term versus short term, what you prefer, what you need to go, because the key here is to work long term. So put long term if you want to think long term, because compounding is what happens slowly and you don't see it until it happens big. But the problem is that plant that Sarah's putting it now needs to be watered and let it grow. And it is only after a few years that she will be able to see the fruits of her work. So that's what it is about. So if you really want to get the strategy, how you should be thinking about your portfolio, there is a masterclass. So if Rupali can share the link or the date, that would be awesome. If you like, maybe just put strategy in the chat if you want to be invited for that masterclass, something similar to what we are doing. It's called Financial Freedom. What's the date there, Rupali, if you don't mind putting there? So strategy is what we should be thinking about, because let me ask you, how many of you are thinking coming to this masterclass of just the next 3-6 months, let alone 3 years, whereas it should be more long term? So keen to explore further, like how it works. This is what I really have to say. So same room, different question, but after everything we have covered, the key thing is, where are you sitting now? What about you? So if you want to talk to us, again, no obligation for us to work. It's really just a chit chat to see if we can be a good fit or help you with any query. If you want to talk, let's put, so it's a quick poll there. So if you want to have a chat with us, with me or my team, Stefan is here as well from my team. Put P if you want to talk. Q, not sure, still thinking, nothing wrong with that. Or R, count me out. Again, that's a great position to be in when you know it's not for you. So put in the chat where you want to go. Talk to me, either myself or Manpreet. Where would you like to go? And yeah, so this is really about it. What we'll cover in this conversation, if you choose to catch up, it's an honest review of your finance and your goals, where you are, what happens to your property, should we be thinking about selling or holding or buying, or what structure you should be considering. Just a candid conversation. It's a clear insights tailored to your situation. Practical tools to empower confident decisions, because the key thing is to have the clarity. What we have been doing this, I've been doing this as an educator, as a strategist, as a portfolio investor for the last 15 years, is the clarity. If you have the clear road ahead of you, you can go faster. But when it is all foggy, it's raining, it's very dark, you can't go ahead, right? So what we are trying to share is our insight that how it can be, some clarity can be added. Again, it's no obligation. It's really, you just walk away with the information. How to book a strategy call. It's a first come, first basis services. Choose a time that suits you. There's no rush. It's transparent. Seems like I'm not showing my screen here. How to book a strategy call. Apologies. Choose a time that suits you. No rush. It's transparent. Simple booking process. It's transparent. So here's the link. If you like to catch up in my time, this is my calendar booking. Rupali has kindly shared in the chat as well, if you like. And yeah, so you can, let's have a catch up. And with that, I'll bring back Manpreet. We potentially can answer some questions further. I know Manpreet has been busy typing there. Any question or any comments, Manpreet, from your side first on what I just shared from my side?
Look, I think you've actually shared a great insight on how it will actually impact the market, because you're working closely with people from a demand supply perspective in terms of how, of course, I've only covered the taxation side of things and how the tax changes will impact people, but essentially how an investor should actually look at their investment journey. That was a very crucial insight in terms of old versus new, and where they should buy and how they should buy and why they should not hold their decision, because the cost of not taking decision is way higher than avoiding.
Sure. No, so
Look, in terms of the questions, I've tried to answer most of the questions where I can in the chat, but look, because people were posting in the chat, so there's always that scroller on. If I have missed your question, feel free to tag your questions, or if you want to raise your hand and ask a question, I'll be happy to answer as much as I can.
Sounds good, Manpreet. So I got a few questions. So admin team has been working behind, so they have collated questions which you failed to answer before. Very quickly. Are we supposed to invest now, quickly, before the effective date? Question by Wendell.
Look, the budget date has passed. So if you are thinking to invest, you can invest now, you can invest tomorrow, you can invest a year after. Just model your strategy and take your decision. It's not going to make any changes if you invest now or a year later. The only change it will make is, of course, as Rasti mentioned, with time, the CPI increase, you want to call it, or the growth in the asset, or the demand and supply balance that is going to shift, we're likely to see some more gains. So I would say, from Rusty's comments, you should take a decision sooner than later.
Yeah, but having said that, I'll probably say never rush. It's a long-term decision, long-term investment hold. So as long as you feel comfortable with your purchase and the strategy and the thesis of the investment, there's no reason for you to hold back. And to Manpreet's point, the deadline was of 12th of May. If you have missed it, we have missed it. Let's not talk about the spilled milk. It's like now time in the market. But to your point, I'll probably also say that there's a lot of uncertainty around people thinking about buying property. There are a lot of people who will rush into selling just because they do not know what to do, because not everyone is well informed. So this could be a good opportunity when people are scared and not buying. And as long as you stick to your strategy, I think it's a great time to jump in sooner rather than later.
And look, there is still supply in the market, as to what I've seen working with a lot of investors. There's still supply in the market. Of course, people start understanding the budget more and eventually start to hold the properties who already have investment properties. So while the supply is there, it's still controlling right balance between demand and supply. So as people try to understand the budget more, we're likely to see less supply in the market.
Beautiful. Hope, Wendell, that answers your question.
Yeah, Rasti, just adding, Manpreet, can you share your details as well in the chat?
Yes.
Thank you.
I'll let you do that. Any question from Rupali that I should answer?
Yep. Quite a few Manpreet has already answered. The one I just saw is from Nidhi. If I am in process of investing in a family trust, should I restructure or just continue as is?
Sorry, what was the question again?
If I'm in the process of investing in a family trust, should I restructure or just continue as is?
Well, the question is, if you're in the process of investing in the trust, the question is have you signed the contract yet? That's the first
Not
question.
yet.
But if you haven't signed the contract, then of course it's important to understand if this trust structure is going to be the right structure for you long term. Of course, when I say that, because other type of trust structures are still excluded from this tax changes, such as unit trust or fixed unit trust, and if your family dynamics are more preferable towards those two structures, you should go towards those two structures versus a family trust, because you'll still get an asset protection and a ring protection against the borrowing in other trust structures and not pay 30% flat tax on the gains.
Beautiful, beautiful. There's a question from Sandeep. When you say this is not a law yet, as we were talking about legislation, yeah, is there any possibility that portions of this may not be passed due to the any pushback, or should we take it for granted?
Look, there is very less likely chances that the capital gains and negative gearing changes are going to be changed substantially or even lightly, because now these were very clear from the beginning. So these were more anticipated changes. So they were doing a lot of work in the background, and already there are briefing papers with the tax department to work the dynamics of it. When it comes to the changes in the trust, which is further a year ahead from 1st of July 2028, we may likely to see maybe minor changes or how these taxes will play out. There's a clarification that we as an accounting advisors, we waiting for from the tax department or from consultancy or briefing papers from the government. But the other two changes, I don't see much changes happening to that negative gearing and capital gain tax.
Beautiful. I like this one. And the question is from Amrindra. How about if you haven't done the settlement, but you've signed the contract prior to the budget night? Does those investors...
Anyone who signed the contract prior to 7:30 p.m., 12th of May, budget release date, you're protected completely.
Love that. So Amrindra, you are safe. Question from Manindra. In family trust, you need to pay tax even you're making loss. It's a question mark.
No.
So
yeah, okay, so sorry, go ahead.
So I'll read it again full. So Manindra asking, so in family trust, you need to pay tax even if you're making loss?
No. So when they say 30% tax, 30% tax is on net distributable benefits. So if the trust is profitable, if the trust has a positive income, regardless of where the income comes from, then only trust pays 30% tax and distributes the money to the beneficiaries.
Beautiful. And so it's only from the profit. So profit and distribution, because people...
No, profit is technically distribution. If you have profit, you'll pay tax and then distribute the profits.
Okay. So if you're making loss, then you just carry your losses.
Yes.
So if you're making profit, first you have to offset the losses from the past before it becomes distribution.
Look,
from the tax point of view?
trust, the only change that happened in the trust is that 30% tax. Losses carry forward was already there. Trusts were never allowed to pass on the losses to beneficiaries. Trust always carry forward the losses until the profits arrive to offset them. The only change is now when the profits arrive and completely use up the losses, now you will pay net 30% tax on the net profits.
Beautiful. And I love this question from Sandy. Does this change make commercial properties more viable?
That's a question for you.
Certainly, like I love the question because it certainly does. But the key thing, lots of people don't really appreciate this, and probably I'll say this on record. Residential property market, the smaller the budget, better it is, because we are talking about the affordability, and when a property which is more affordable is more in demand. So the matrix of a smaller size budgeted property on resi, it makes sense. But on the other hand, for commercial, it's the other way around. When you have a bigger asset as a commercial property, then it makes better sense rather than buying a retail office or a small coffee shop. It doesn't make sense because the risk is a lot more on the economy and the neighborhood and the economy of that cafe as well. So just be mindful. It's not a like for like comparison. Commercial is more viable for sure in this environment, but doesn't mean that residential is not. But it needs to be in your scenario, Sandy, that it is really the right investment type and the budget, because even the LVR is a bit lower on your commercial property. So you need to put more money. Like in resi, with 10% LMI, you can buy 100% of exposure in resi. Whereas in commercial, it can be 20%, 30% that you need to put deposit on. But yeah. Mike, I see your hand up. I'm not sure whether by mistake or there. So by all means,
Yeah, I got a couple of questions. First of all, I'm still confused. So what rights were actually lost 2 days ago?
So say that question again.
So what rights were lost 2 days ago on budget night? So if you owned a property before that, you could do what that you can't do today?
Okay, I'll try to answer this so that Manpreet can fix it up. So if you are buying property in super, no changes. If you're buying a brand new property, no changes. If you already hold a property, no changes. So nothing has changed. But Mike, if you're about to buy a property outside of your super,
Today.
and that to establish property, which I made a point for, in that scenario, all you're losing is the right to get the negative gearing benefit immediately.
Okay, because the negative gearing thing had a date of 1 July 2027. So then what's that date about?
Okay, so what it means is what I'm saying or what Manpreet is saying is actually applicable from 1st of July 27.
So
if
not
you buy
from yesterday.
You still have 1 year to benefit from that negative gearing as if you're buying the old world. But from 2027, because you just bought after the budget date, you will lose the right to take the benefit of negative gearing immediately in that year after 1st July 2027.
Okay, so if I buy an existing property now, then from 1st of July 2027, I won't be able to negatively gear on that existing property. I will be able to negatively gear up to the 1st of July 2027, but after that, I won't be able to. All right.
Mike, I'll probably clarify one subtle difference, and that is negative gearing is still there. It is still there. It just doesn't happen the same year. So
yeah,
this
you can't, and it's not against your personal income. It's carried forward.
Yeah, so it's negative gearing is not against your personal income, and that's why we have to hold it until the property starts making money.
Right. And that was my other question. Like, how long can it be carried forward? Indefinitely?
Indefinitely.
Okay.
And if the property is negative gear forever, once you're selling it, all the losses can be recouped from your proceeds of the sale. So for example, I made 50K loss in holding the property for say 10 years, and now made a profit of say 400K. Now, first thing I need to do is reduce that 50K from just offsetting my loss first. Now my capital gain tax, based on what we just discussed, that is based only on 350K now. So negative gearing is not removed, and that's what I'm saying. It's a bit hard for us to really get the nuances out. It's just the timing of that negative gearing, because timing is based on now on the income from your portfolio rather than your wages.
Okay. Then I've got a third question.
Am I correct in saying this, all of this?
Sorry?
Okay, so yes, you're correct. I mean, it's just the timing. Of course, we're saying negative, we'll lose the negative gearing. We're not losing the negative gearing. We are losing
It's
it
still
to
there.
claim it in the current financial year against the other incomes that we have, against our income or wages or
Personal.
salary or business income or distributions.
Right.
But if you're buying new super, still there. If you're buying a new property, still there.
Well, that was my
And
other
for 1
question.
year,
So if
still
you
there.
buy an existing property in your super, even say after 1st of July 2027, you buy an existing property, not a new property. You can
So
use that against your
buying super
okay.
has to compensate all the income from your super only. So it's still not touching your personal income.
Right. Okay.
So super is a separate entity, Mike.
Yeah, because it's not against your personal income, it's against okay. Right.
So look, as I said, in my opinion, budget was scary to get into, but it's, to me, I'm celebrating it as a property investor.
Look, that's where the importance of strategy, to answer your question like that, that's where the importance of strategy comes in, as you said. Buying in super, how can I use, because negative gearing benefits you can still claim in super. How do I use it to my advantage now and claim it against my personal income? There is a way to do that. This is where the strategy comes in.
Buy the
Awesome.
new stuff.
Hope that answers the question, Mike. Stay on. There might be more questions that might help you or come to your mind as well. Moving on, question from Doreen. What about in SMSF? Do I have to pay tax? How is it calculated?
In SMSF, well, let's talk about quickly 3 taxes. SMSF taxes are capped at 15%. So if you hold any asset and make any profit and you sell the asset within first 12 months, of course, you pay 15% tax. If it's sold after 12 months, you pay 10% tax. That's capped. And if you sell it after 60, or if you have retired, or if you started a pension in your super, then you pay 0 tax.
Brief answer. SMSF workshop where Manpreet will be talking about a lot more detail in 90 minutes about this. The session is the 27th of May. Put in the chat, team will register you there. Great question. Question from...
Can I ask one more question? I'm
Yes,
Doreen.
please.
Sure.
Yes, please. Hi, Doreen.
Can
How are you
we
doing?
able to buy old property, whether we had to under SMSF?
You
Yes,
can do
you can
whatever.
buy
You can do
property
whatever. It's
and
your
you can
money.
It
still
doesn't
claim
affect the
negative.
negative gearing or anything.
No, it doesn't affect negative gearing. You can still claim negative gearing benefits. You can still, old CGT rules still apply to SMSF. So essentially, this budget has not touched anything to do with SMSF.
SMS. Thank you. Thank you.
Awesome. Thank you, Doreen, for the question. Question is from Maninder Singh. Does this negative gearing grandfathering comes with an expiry date?
Well, no, as of this budget, there's no expiry date to grandfathering. Of course, after 5 years, they release another budget and put a stop to something, then we never know. But as of now, no, there is no expiry date to this.
And knowing situation from Maninder, that's the reason why I would say is that hold as much as you can for, because there's no point in selling now if you don't have to, because there's a lot of advantage of the negative gearing that you would be really celebrating, even on the property which you just exchanged, because it really covers on that as well. Good. So there's another question. Does this also impact the 6-year rule for CGT? So there's a bit of confusion there. So I'll let you clarify that 6-year rule for CGT.
No, it does not impact 6-year rule for CGT, because 6-year rule brings you complete tax exemption. So you will still be eligible for complete tax exemption if you fall within that 6-year eligibility criteria. So no, it doesn't impact that.
Cool. Thank you. Question from Sandeep. If there is a simple family trust holding just one asset, does it make family trust less attractive due to the admin requirements compared to individual name, assuming no bucket company and beneficiaries already being taxed at 30%?
To answer your question, Sandeep, yes and no. Because family trusts are not essentially just set up as a tax protection vehicle or tax minimization vehicle. Family trusts are also set up for asset protection. Family trusts are also set up when you want to pass on the properties to your kids. So there are multiple other reasons where one would set up family trust. And also because some banks treat family trusts differently, and that 30% tax applicability is when your trust has a positive income. Now, if the trust has a positive income, it also creates a ring fenced against your finance situation. Of course, things tend to change on and off, but there are other reasons people do set up family trust. So it's not necessarily unattractive. There are, of course, this is where you need to do your modeling of your situation and decide if this is the right structure for you.
Yeah. Is Gail around? Because I would
Yes.
probably also argue. Gail, tell me about, sorry, you there. Sorry, apologies. There's a
I'm here.
benefit of buying in trust from the borrowing capacity. Would you mind explaining to us, please?
So just sharing, Gail is a mortgage broker.
Yes.
Thank you.
So the benefits of buying in a trust in the previous structure.
Sorry to put in the spot there.
Yeah, I mean, obviously, it was probably used to distribute income to different people and entities. So obviously, when the lenders work out your borrowing capacity, that will take into account the tax that you pay on that entity as such. Is that what you're referring to? Or?
No, sorry, I put you on the spot there. So
Yeah.
the question is, sorry, apologies. I'll try to explain and try to get more of a confirmation. That's okay.
Yes.
So
Yes.
Manpreet was just explaining, one of the member here, the benefits of buying or the pros and cons of buying in a family trust. And Manpreet was saying, hey, it's about asset protection. Is it really? It's also about estate planning. And I wanted to put my hand up and also saying that, hey, it could be also a hack to get more borrowing of the bank, just because when the trust becomes independent, the borrowing now
Yeah.
here, now let's talk about it.
Yeah, now I know what you're referring
Apologies,
to.
apologies.
So exactly right. So if you buy in a trust or a company, and you borrow against that for property, there are some lenders that will disregard that entity on the next loan. So that allows us to structure, more of a long-term strategy for clients based on that. It's very selective. Some banks don't work in that space, but some definitely do. So
Yeah.
yeah.
And that's where I've always believed that let's not take a generic answer one way or the other. There are always some exceptions, and that's where we need to have the right team. And I happily want to share that we work very closely with Gail. So Gail is accountant by qualification and by experience as well, and she has gone to the mortgage side, who can talk about the structure and whatnot a bit more fluently. So if you don't mind, Gail, if you don't mind putting your details in the chat as well for anyone who want to catch up with you or ask any questions directly, by all means do that. So no, thank you so
Rusty,
much.
I'm just sharing it's 8:51. I know all three of you are there to share a lot of questions and answers from everyone. We will be trying our best to answer your questions. So probably let's put a timer and see how we go. Yeah.
Sure. No, thank you so much. I get it away. So very quickly, so Manpreet, are you okay to stay a bit longer? I know it has been a long day for you. We have been talking about through the day. Is it okay for the next few minutes? I want to answer a few questions.
Oh yeah. I'm an hour behind your time anyway, so it's fine.
Cool. Question from Craig. Do you see any changes from the banks for existing investors who need to refinance their interest-only loans? More of a question to Gail, if that's okay.
I definitely don't see any challenges there. Banks are still offering interest-only loans. The thing that we probably will see change is when we do loan servicing, we do get to take into account negative gearing. So I imagine they will adjust based on the client situation, with some properties still being able to be negatively geared and others not. But interest only, that's not a problem. It's just a matter of making sure your broker looks across all of their lenders to find the best option. So
No, totally,
yeah.
totally. And remind me on this, like earlier there was a rule, Gail, that you can only have interest-only loan for only 5 years. But I saw that a lot of people were still able to get other extension of 5 years. What's your experience on that?
Yeah, there are some lenders that do more than 5 years, but we always have to remember with interest only, it does restrict our borrowing. So, you know, if you have 5 years, the lender will assume your loan term is 25 years. So,
Yeah, and of course, there's a pros and cons,
yeah,
but at least the choice is there.
absolutely, the choice
I
is
would love to
there.
pay for 30 years and
Yeah.
pay the whole principal back later on.
I
But
mean,
that's me.
that's right. I mean, you just need to review your loan regularly. And then that may just be renewing that interest only period. So,
Sure.
yeah.
Totally. No, thank you. Thank you. Really appreciate it. Question from Ahmed. Which one is eligible in regards for valuation? Will it done by real estate company or valuation dealer, be bank or BMT like company? I'll answer that one. Ahmed, the thing is that it's really in your benefit. It's only $500, but the modeling that I've done, it can actually save you 30, 40, $50,000 down the line. Now, you don't want to rely just on the valuation from your real estate company next door or a bank valuation. The key here is to go for a approved valuer whose job is a valuer and can write you a valuation report. I would also argue that one should probably go and invest $500 few times, 2, 3 times, get multiple valuations, and take the one which suits you the most. Yes, the companies like BMT or Duotex, all of that, like more than happy to introduce. But right now, the deadline is not now. It's actually, Manpreet was just giving a heads up that it's required after 12 months or so. So not required yet, but yeah, it's a valuation company. I can put it in touch if you like, who gives us some discount as well. Question from Bing. Buying an established property and no negative gearing. How much borrowing capacity is reduced by? Being talk to someone like Gail, because it's really, really a question of the quantum of negative gearing and was it really required? Is it the marginal thing? Like if somebody has a borrowing capacity of $2 million and they are out to buy a 700K property, no change whatsoever, right? But if it was already tied for buying a 700K property and this budget changes things, then of course it will be reduced. How much depends on many factors. And I think Gail would be in a better position when she has access, or someone like Gail, not just her, who has access to your numbers, maybe to answer that, if that's okay. Other question, maybe more so for Manpreet from Bing. What about buying existing property in company? Can you negative gear against other company income or just against rental income? Great question.
Look, I don't think this is where we're seeking more clarification as well, but I don't think you can claim rental losses against your business income or other category income. Reason being, then it will defeat the purpose of the law because the law is you cannot claim rental income losses against other income. So it is likely, but this is where clarification paper is required. We will eventually have clarification on this once this becomes a legislation.
Cool. Look, I think there are a few more questions. More than happy for you to drop email. I just want to be conscious of everyone's time, and also we have already gone a lot of minutes over. So from my bottom of my heart, I really want to thank everyone who is keen to learn or get informed better, because if you're well informed, you can really take more informed decision. Of course, take informed decision. What I'm talking about now at 9 p.m. So look, I really want to congratulate you because you have been curious to learn. Hopefully, you are in a better position with maybe more definite questions in your mind and plus some answers already from Manpreet and Gail. So thank you so much, everyone. Is there any last comment that what you took off or anything about Manpreet or Gail or about myself? If you feel like, by all means. Hope this session has been worthwhile. We do run these sessions regularly. If you know someone else who's keen to learn, by all means, allow me to send some follow-up email if there's any more questions, because someone like me, we think back, come back with more questions, by all means, feel free. You got Manpreet's email address. You got email address of Gail, I think. By all means, leverage that. This is for you, and we are here to just support you. So thank you so much, everyone. Last comment from you, Manpreet, your comments before you move on.
I
Then
just
I'll
want
pass
to
it to
thank
Rupali.
you, everyone. who actually spared time to understand the budget, of course, the strategy. Of course, I believe you all had a lot of questions, and this has given you enough clarification. Me and Rusty and Gail, of course, we've tried our best to give you your answers to make your calculated decision. So here on, good luck, make your right choices. And if you ever need us to have clear any questions, feel free to reach out.
Gail, anything from you? Thank you so much, Manpreet. Really appreciate it.
I just think it's just some changes that we have to adapt to, and exactly as Manpreet was saying, just look at your scenario and work out your best options going forward. So, along with your team.
Awesome. And I say this thing that knowledge is powerful, but if you don't use it, it doesn't go anywhere. So it's best to be informed and ask the right questions to your advisors. Maybe you're more informed now. Let me pass to Rupali to make a closing on this, if that's okay with you, Rupali.
Thank you so much. Thank you so much, everyone. We have tried our best to answer all the questions. If you think that's anything specific you need to know, you have all the links of the calendar links as well from Gail, Manpreet, and Rusty. We will be sending an email. So if you have any questions, do reply back with your questions. We'll answer it. We will process the recording and we'll share the recording over the time as well. Thank you so much. Yeah, I think dot on 9. It was a 90-minute sessions, but we did well.
Least before I forget, like Stefan has been there. So thank you so much, Stefan. Really appreciate it. Stefan is the person whom you might have heard on the phone. So apologies, mate. I didn't really see you before. Stefan, how are you doing?
Good. Sorry, it's good to finally get informed about everything. Obviously, talking on the phones every day, people always have a lot of questions. So it's nice for all of us just to hear you speak and get some clarification on everything, which is really good.
Awesome. Thank you so much, everyone. Have a great night, and see you next time. Have a great night. Thank you so much.
Thank you.
Thank you, Manpreet. Thank you, Gail.
Thanks.
Thank you, Stephen and Rupali. Appreciate it.